Earlier this month, President Donald Trump announced new global tariffs, sparking economic uncertainty and raising costs for American families. These tariffs, which will target imports from several countries, will worsen inflation and push prices higher, creating a tough financial situation for many. The U.S. has imposed additional tariffs on imports from regions like China, Europe, Japan, Southeast Asia, and India. Some African countries are affected as well, but their smaller economies don't significantly impact global trade. The primary goal of these tariffs is to reduce the U.S. trade deficit, meaning the country aims to lower the amount of purchases from these nations compared to what it exports. In this video, we'll explain how this tariff policy can raise living costs and may lead to increased credit card use, resulting in a situation known as the double whammy that can make you struggle with rising expenses while falling deeper into debt. I will also share practical tips for maintaining financial stability in tough times. So let's begin. Tariffs and inflation relationship. Tariffs and inflation are connected because both affect prices and the economy. A tariff is a tax on goods coming from other countries. When a tariff is added, the price of imported goods often goes up. This doesn't just make things more expensive for consumers. It also affects businesses that need these goods to make their products. Companies facing higher costs often raise their prices to cover extra expenses, which can lead to overall price increases, causing everyday goods and services to become more expensive. As a result, inflation rises because people have to spend more money on the same things they used to buy for less. As prices climb, people use credit cards more to cover their expenses, leading to the double whammy. Families face rising costs while also growing debt. Since interest rates are rising, paying off credit cards is even harder, trapping people in financial trouble. Over time, this affects the entire economy, making jobs less secure and saving money more difficult. To handle this, people need to spend wisely, reduce reliance on debt, and find better ways to manage their money. This can help them stay financially strong despite rising costs. Causes and effects of credit card use. During economic stress, Americans often rely on credit cards to handle financial challenges by covering daily needs like food and bills when incomes drop or prices rise. Many people without enough savings turn to credit cards for emergencies, while high inflation further pressures families to borrow. Credit cards are convenient and easy to use, but depending on them too much can lead to big debts because of high interest rates, turning a short-term solution into long-term problems. Having too much debt can hurt your credit score because it shows lenders you might struggle to pay back money. A lower credit score makes it harder to get loans, credit cards, or even rent a home. If you do get approved, you might have to pay higher interest rates, costing you more. It can also make it harder to get a mortgage or start a business. Managing your debt carefully helps keep your credit score strong and gives you better chances for future financial success. To stop relying too much on credit cards and falling into debt, people need simple steps to handle rising costs. Once they understand the problem, they should focus on finding clear and practical solutions. Here are some practical suggestions to help you maintain financial stability in tough times. First, creating a strict budget. By tracking your spending, you can see where your money goes and cut unnecessary expenses, such as eating out or unused subscriptions. A clear budget helps you stay in control of your finances by ensuring you can set aside money to pay off debts on time, avoid high-interest charges, and save for emergencies. This way, you can lower stress and avoid falling deeper into debt. To help you get started, here are some practical tips for creating a strict budget. Track your money. Write down your monthly income and all your expenses. Smart budgeting. Set spending limits for non-essential categories. Create shopping lists. Plan your grocery shopping and stick to a list to avoid impulse buys. Second, reducing credit card use. Using credit cards less often helping you avoid large balances and high interest charges. Focus on paying for essentials with cash or debit cards, so you're only spending what you already have. If possible, save a little money each month to use for emergencies instead of turning to credit cards, and use credit cards less often to help you stay in control of your finances. To make this easier, here are some practical tips. Smart spending. Use cash or debit card for daily costs like groceries and transport. Direct payment. Pay bills directly from your bank account, not your credit card. Set a limit. Decide on a weekly spending limit and stick to it. Third, debt repayment strategies. Paying off debt helps with rising costs and keeps money problems from getting worse. One smart way to reduce debt is the avalanche method, which targets high-interest debts like credit cards. Paying more than the minimum each month helps reduce debt faster. Another good method is paying off small debts first, then using that money to handle bigger debts. This is called the snowball method. With these strategies in mind, let's explore practical actions to repay debts effectively. Make extra payments. Aim to pay at least 20% more than the minimum each month to accelerate debt reduction. Create a fixed debt repayment fund. Set aside a specific amount, like 10% of your monthly income, strictly for debt repayment. Use windfalls strategically. Apply tax refunds, bonuses, or unexpected income directly to your highest priority debt. Fourth, find ways to cut interest costs. Cutting interest costs can help deal with the double whammy, where rising expenses and debt make life harder. High interest rates make debt grow quickly, so lowering these costs frees up extra money to cover daily needs without overusing credit cards. By spending less on interest, you can manage your debts more effectively and avoid falling deeper into financial trouble. Improving your finances by reducing the burden of interest can be achieved by considering these practical actions. Refinance loans. Consider refinancing your mortgage or loans to replace high-rate debt with one that has a lower interest rate. Balance transfer offers. Move your debt to a card with zero or low interest for a limited time, but watch out for fees and higher rates later. Debt consolidation loans. Combine multiple debts into one loan with a lower interest rate to simplify payments and reduce monthly costs. Fifth, build an emergency fund. An emergency fund helps you face tough situations, such as unexpected bills or job loss, without borrowing money and risking debt. It serves as a safety net, reducing stress and protecting your finances during difficult times. Begin by saving 3 to 6 months' worth of living expenses in a separate, easily accessible account. This fund prevents you from falling into a debt cycle and provides peace of mind, knowing you're prepared for life's uncertainties. To help you get started, here are some practical actions you can consider. Open a separate savings account. Set up a separate account just for your emergency fund so it stays safe and easy to manage. Set an initial savings goal. Start with a realistic first milestone, like saving $500 or 1 month's rent. Save a set percentage of income. Dedicate 10% or any manageable percentage of your income to the fund each month. In the end, understanding how tariffs, inflation, and debt are connected can help people take control of their money. Careful spending and reduced credit card use can prevent rising costs and growing debt. Simple actions like budgeting, saving money, and staying informed can help people manage financial problems and work toward a steady future despite inflation and tariffs. Thank you for watching. I hope you found them helpful and informative. If you did, please give a thumbs up and subscribe to my channel. And I'll see you in the next video.